Everything is pointing out to here. So we broke out of this, whatever range we got here. Now we're back in it. So 50% of this is doable. Let me get the FOMC. Let's go. FOMC meeting. We are in July. Where's the calendar? Okay. Can we turn this off? I kinda don't like this. Shoot. I gotta close this. Oh wow, what just happened? What the smokes? He haven't even come out yet. What the smokes? Okay, that's what happens. Oh, he did just came out. So did they left rates the same or what? I imagine they did, if that just happened. Gotta go faster. FOMC live. He's right main channel. Oh, he's talking here.
Wix, one platform, any website, unlimited creation.
See, 2 years is going to be very different and even more effective. So I think it's really hard to know. Of course, there are optimists who feel like it's going to make everybody much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Greg.
Thank you. Greg Rapp from MarketWatch. I was wondering if you could step back a little bit, Chair Powell. There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the dollar, movements of the dollar was impacting the economy. Are we going through something like that now? That, are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. From a geopolitical standpoint, from a trade standpoint, from an immigration standpoint. You see this not just here, but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. I mean, but and it doesn't change our objectives or what we need to do. And you know, these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. You know, will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. You know, AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know though. So both housing services and non-housing services have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news.
Come on, give me this shirt first.
Goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, you know, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more, and we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about, you know, responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And, you know, our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjust it over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term as you get out to the later years. It's hard for anybody to know where the economy is going. You didn't see people moving their longer term, you know, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, 1/10 tick up in unemployment, and you see inflation moving up 3/10. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said
Damn,
was that
my trade is
uncertainty
gone.
uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So, and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the war won't be over.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber, Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool
No
and is back
way.
to roughly 2% despite the tariffs. And I guess I also wanted to ask about, cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some
I
housing
can't
data,
go as a
including
guess.
this morning, that has
That's
been pretty
crazy,
weak.
but
Do you see any
supposedly,
concerns that the economy is weakening and that is a reason?
supposedly Jeremy Powell chose this is funny. Let me show you how this. What's it called? Watch. Guru. This is funny here. President Trump says he heard Fed Chair Powell will cut interest rates in September. What's happening?
Situations. We have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very slow continued cooling, but nothing that's troubling at this time. But we watch it very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to
Check this out
economic
here.
developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given
Actually,
that there are
let me
concerns
leave
inflation
that
will
one,
rise, but there is the alternate scenario
Let me
that
hide it.
tariffs
Oh,
would
I can do that.
create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we
Wow.
think, and where the labor market does or doesn't
That's
soften.
a fake wick.
And I think what you see people doing is looking ahead
This is easy.
at
180 is
very high
easy.
uncertainty and writing down what they think the most likely case
Might
is.
come up to
No one holds
181.
these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them
Yeah,
saying, yes, I
this
think
is
we will get
possible.
to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
So, looks like we had a range.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth, and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see whether, to the extent to which they do over coming months. And I think that's
Wow,
going to
that 15-minute, that is crazy.
For one thing. In addition, we'll see how the labor market progresses.
Okay,
So
let's take this out
at
of
some
here.
point, it will become clear.
Just
I
wanted
can't
to
tell
see
you
if I
exactly
see
when
clear.
that will be. And meanwhile, we'll be watching the labor market
Bro,
very
just
carefully
give me a
for
take
signs of
profit
weakness
down
and
here.
strength,
Come on.
and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think
usually we
we
see
don't
bigger
yet know
wicks.
with any confidence where they will settle out.
Like
We have an estimate.
crazy
And it's a
wicks.
pretty. I think all estimates are now pretty close together, but it's highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff, but together they will all pay for it together, or maybe one party will pay.
So
it
we
all.
went up.
But that process is
But
very
take it
hard to
from here.
predict, and we
So it
haven't
gotta
been
be
through a
this
situation
low.
like this,
Well,
and
that's
I
not
think we
there,
have to be
so-
humble about our ability to forecast it. So that's why we need to see
No,
some
that doesn't
actual
make
data
sense.
to make better decisions. We'd like to get some more data, and again, in the meantime, we can do that because the economy remains in solid condition.
Nick Demeros of the Wall Street Journal.
Yeah,
Chair
so
Powell, I guess
180
I'm wondering if you could
is
explain
key
a little
right
bit
now.
more the
level
divergence
right
we
here is
see in
key.
the dot plot, particularly around the
If we
2025
break that,
rate
which we already
projections.
tried,
I realize this is, you have one group of officials that are putting down
then
no
we go
cuts,
higher.
another that are putting down more
But
than
right now,
one.
this is our ceiling
Um,
right now.
And again, recognizing that could be difficult
Who's
to
this
summarize,
dude,
but
bro?
is it a matter of
Who
people
is
having a
this
different
dude?
outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things, and I think as the data come in, you should see those differences diminish.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think about
whenever that's going to happen.
Wouldn't you rather get legal advice when you need it, move at your own pace, and have a clear
to look at that and because because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction, and I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers, about the outlook for the economy.
Look, from my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
He said, I'm not thinking about that.
Thanks, Mr. Chairman. I guess with workplace raids increasing, picking up significantly, what kind of effect would that have on the labor market
Sorry,
in the short
with
term?
what picking up?
Workplace raids.
So you're asking immigration?
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SCP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SCP is part of it. Many other ideas. It's sort of how do we think our communications can be improved? There are a number of ideas. People offered a really, it was a great conversation. Number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You've said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today and you didn't cut today?
Well, the forecast for inflation in December was
Damn, she pretty, bro.
2.5. Core PCE for
Is that Juanita?
2025. The forecast was 2.5%.
She rejects me every
good
time,
inflation
bro.
forecast.
I think that's Juanita.
I think what we've learned is that, and this was long before we had any idea of what the actual policies would be. We've learned that tariffs are going to be substantially larger than forecasters generally thought. And, we don't, our forecasts are generally not particularly different from those of other, well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming and that would mean higher inflation. That's what happened. And so you saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that,
Juanita.
I think consumers, right, we're looking for relief
Bro, she
on
got some
rates
big
when it
ass
comes to
eyelash-
mortgages, car loans,
eyelashes.
small
Look at that.
businesses want to take
Bro,
out more manageable loans.
Oh.
When you look at the cumulative inflation
Like,
over the past
sweet,
5
bro.
years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts
Dude.
the American consumer?
Dude, they look
Well,
alike.
I mean, we're trying to restore price. The best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis. That, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation.
No way.
Well, sales objection.
Two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and
What
then
time do
we
we
can
have
start to make a better
Trump
judgment.
talking?
So that's what we're doing, and I think we can take the time to do
4
that
p.m.,
because
so we have,
unemployment
like,
is 4.2%.
an hour of
Wages are moving up.
the
Real
market
wages are
just-
moving up at a healthy clip now. And inflation is, 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
I think
Thank
we're
you, Chair
going
Powell.
down, man.
So
165
you're saying that
is
uncertainty has come
dude.
down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional, forecaster with adequate resources and forecasts for a living is forecasting pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs because someone has to pay for the tariffs. And it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind or just the consumer buying it, and all through that chain, people will be trying not to be the ones who pick up the cost, but ultimately the cost of the tariff has to be paid. And some of it will fall on the end consumer. We know that because that's what businesses say, that's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
And follow up on that. So you spent years though talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward-looking. That is elementary. You've got to be looking at, I always talk about the incoming data, the evolving outlook, and the balance of risks. That we say that over and over and over again, right? So it's always forward-looking. If you know, at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Thank you. Amara Mokwe with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention,
No.
So I was asked, is
scandal
the
wouldn't
Fed
look good
overstaffed?
if it closes
And I
here.
said no, and I sort of said as a pun,
mean,
overworked but not overstaffed.
no.
People do work extremely hard at the
the
Fed,
day
and
might
I know they work
close.
hard at Bloomberg too. So, but we do, we work hard, and
The answer to this was
but I
New
would
York
say this,
Open.
so we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public. We're going to demonstrate that we are good stewards of public resources. So we thought, and I thought, that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it, again, respecting that we have critical missions to carry out. I've had experience, a lot of experience in my prior careers.
It's going to be the
with,
Jeremy Powell.
headcount reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning. And you do it over a period of time.
Let's see when we break through it.
I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions. And I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026.
Not a lot of movement today.
Thank you.
Yeah, so
80.
You know, we don't sit around and debate
Oh,
or
wow.
really
We were at
discuss. We take
77.
fiscal policy as fully exogenous.
$2.
And so we actually, you know, really didn't talk about the bill or the contents of it. It's still evolving.
I went from irregular eating, fatigue, and the gym 6 times a week to healthy eating habits, productive days, and the gym.
And you know, I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, you know, we don't know the outcome yet there, so hard to be real specific.
Neil. Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks. Worries that long-running problems around funding and response rates may be getting worse.
Applications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
What just
We
happened?
at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Oh, you're gone. That's crazy.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So
What happened
as you
to
know,
Jeremy
today
Powell?
We decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive.
What happened to Jeremy Powell?
Inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So, just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates,
We
outside
breaking the
estimates
lows.
of the likely,
We continuing to move down. This is
I
definitely.
ordered 200 hand-forged knives to my dorm room and built a Wix website to sell
bear
them.
dibs all throughout here.
we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge, but
Why is
it
it
feels
black?
like there's
What the
much
hell?
more to come, as well, looking ahead.
Oh, yeah. What am I doing?
Hi, Mr. Chairman. Neil
I
Earl
need
with
a
Axios. This morning we got a GDP report in which final
I need to make
domestic
this,
private
like,
purchases
white.
decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly,
Boom.
as I mentioned in my opening remarks, economic activity data, GDP,
Boom.
and private domestic final purchases, which we think is a narrower but better signal for future. For
We
where the
going
economy is
down
going,
for
has
real.
come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5%.
Are we about to
last
break
year,
it?
so that
Are we
has
about to
certainly
break
come
Jeremy's
down.
Paul
But
little range?
if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see
Boom.
weakening in the labor market.
Now can we
You do
close
see a slowing
candles
in
below
job
it?
creation, but also in a slowing in the supply of workers. So you've got a labor market that's in balance, albeit
Wow.
partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable. Which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody, and also from a dissenter, is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table, where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you ask about the June SEP, I wouldn't, that you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be at some point when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream.
Eating the volume, eating the tax or the tariff.
Most people are too lazy to do this, but it saves homeowners.
It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean I wouldn't insist upon that. But I don't think I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like on fiscal legislation or other legislation for that matter. But I would say when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government.
We just broke down for
our rate
real.
changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good for. If we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria.
Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over.
See what's going on.
To visit a building, but it was a good visit.
Are there any aspects of the project that they've raised that you see
We
as
haven't had
making you reconsider
anybody
aspects of the
close
project?
below this.
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometime early in the year.
All right, we'll take profit at 75.70.
So I have a hot take. AI is not just a buzzword if you use Monday CRM.
I'm so glad you.
There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through.
Oh shit, I'm almost there. Lord. 3
or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate, kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed.
We've been here before.
And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down
that's
nicely.
definitely broken next
Goods
scandal.
inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. You know, people in the economy, they use this data a lot too, so it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Let's go down for real.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're showing no
This is
significant
such a good
upward
shirt,
trend
but
in
I
inflation
need to
over the
take
past 6
profits,
months,
bro.
that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
Why am I taking profit here?
How
Because we already
concerned
hit the
am I
golden
that-
pocket
can you say that
once.
again?
The wait-and-see approach.
And the next thing will be the
wait-and-see approach,
barrier
what do you mean?
low
For cutting
or the
rates.
big
You're waiting to
range.
see if the tariffs will
So,
affect inflation. So
you
it's a
could
wait-and-see
say you
approach.
go
So
long
that-
from here.
You know, we're
I'm
policy's
gonna to
restricted.
here.
When we start cutting, it'll go toward neutral.
Okay.
Or-
That's delay, though.
Nah,
where you're
it's
saying
just
it's a
so many
one-time-
lows here,
one-time
so
price increase
yeah,
for
this right
tariffs,
here,
which possibly
178.
could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the
Wow.
tariffs and all of the discussion.
That's where I
about,
will
you
have
know,
taken
if
profit.
you know, if the companies will raise prices when and as they can.
This is about to break.
And you saw it famously
Yep.
in the first administration of President Trump during those tariffs.
Wow. Let's see
washing
how many
machines were
people
tariffed, but
have a
but
second
dryers
belief
weren't.
on the golden
But what do
pocket.
you know, price
Let's see
of
let's
dryers
see
went
how
up
many
too, just
people
like,
believe in a golden pocket
washing machines. So
for a
companies
second
will
time.
often just go across the street.
A
And
lot of
if
longs
you
just
know
got
what I mean.
opened.
That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings
Okay.
of whatever the effects turn out to be on goods inflation. And you know, I'll say again, they may
Come
be,
on, give me
they may
70,
be less
give me
than-
70, bro.
than
You're
people
already at
estimate, or
75.
more than
Come on,
people
come on.
estimate.
No,
They're not going to be zero.
I should take
Consumers
profit
will pay
because I
some of
think we're
this.
coming up at least
Businesses
half of
will
this
pay some
candle.
of this. Retailers will pay some of this.
I did not take
but,
profit.
You know, we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things, really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
75, 77.
Well, so the housing is a special case,
Come
right?
on. 18 cents away. Come on, 18 cents away. Oh my God.
We set an overnight rate, and the rates that go into mortgages are longer-term rates, like treasury rates might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect.
Oh,
we do
wow.
have an
There you
effect,
go.
But we're not the main effect. There are other things going on in the housing sector.
It was so
and
close.
One of those is just there's a kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, and that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. I mean, we've made a lot of progress toward that. We have a very good labor market right now.
Boom.
Inflation, we were very close to 2%. We're seeing some goods inflation move us away.
No
so
way,
far not very
bro.
far away.
It did. It hit. Exactly hit. Exactly
Hi,
hit.
Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the
situation we're in, which is we have two-sided risk to both of our goals. When we paused,
we injected
inflation
Jeremy Paul.
was above target,
It's not
and
working.
the labor market was pretty good. So
But it played
that
out.
was a
My short
time when
played out.
Policy was restrictive when we paused, and to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move.
My short played out.
Closer to neutral, and that the next steps.
Kind of
that we
want to
take
put
are
that
likely
long,
to be
but
in that
honestly, I
direction.
really
What
don't.
will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting, Will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down closer to 2?
We'll look at everything. It's as I mentioned,
let's go down for real. The last hour of the hour.
Price increase, and in the end, we'll make sure that that's the case.
Come on,
we're just trying to do that
imagine.
efficiently.
This is a knife,
the
bro.
timing right, so we don't again if we go. Rates too soon,
I'm just gonna leave that long in the chart.
Inflation. There's history is dotted with examples of that.
Not really planning on taking it.
Maybe you're doing unnecessary damage to the labor market. So we're trying to
just
get
because of the way this is coming down too fast, like too fast.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that may be complicating your attempts to get inflation back to target. Thank you.
This goes back to the division of labor between the Fed and the Treasury, as you I'm sure know, and the Treasury only
I don't think
speaks to the dollar.
You know what?
It's not something that's been
I don't like it because this is catching a knife.
Major discussion at all at the Fed. I wouldn't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the U.S. economy? Thank you.
We're monitoring the situation. We do, of course, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But we really need the government data. Really is the gold standard in data, and we need it to be, to be good and be able to rely on it. And
be careful trading this.
Substitute for that, but if we'll have to make do with what we have. But I certainly hope that we get what we need.
Be careful trading that. I think we're just gonna smack through that.
Brian, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you.
Oof.
Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that. I think that having an independent central bank.
That is crazy, bro. If
arrangement.
If you're gonna come this low and then go up, at least can't get this long.
It should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us and other central banks, what it gives you is
this
the
long is
ability
not
to
gonna
make
pay out
these
because damn,
very challenging decisions.
It's a knife, boys and girls.
The data and the evolving outlook, the balance of risks, and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example.
Wait, what just happened?
That's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress.
Wait.
And I think it's very important. I'll just say that.
Maria Eloisa. Afternoon, Sir Powell. Maria Eloisa Capurro from Bloomberg News. You mentioned
The market is having a meltdown right now.
I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has.
Take back control of your erections and optimize testosterone through HEMS.
What the fuck just happened?
Includes prescription strength tadalafil for longer lasting
My chart is not up to date.
Feel younger, stronger, and more energetic.
And delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing, but so.
Mexi's going crazy. What the fuck is happening? Bro, this chart is not even loading yet. Bro, I think we're like down here. My chart is not even there yet. What in the smokes? Are we going to 167? My chart is not even loading, but we're not there. Bitcoin is at 115. Let me see. And I cannot even talk right now. Okay, Bitcoin is okay, so Bitcoin is good. Solana, on the other hand, this thing is not up to date. Because I'm here on the exchange on the phone. On the phone, we're at 172.50. On here, we're at 173. That is crazy, bro. Matter of seconds. Damn. Damn. Is this like another bear market type shit? Bro. This is the SFP that we just did on the exchange.